already we've seen inheritance tax has been extended to include pensions. And we have to think about exactly what that means. It's actually quite deep-seated. In 2015, capital gains tax changes were changed on property, and the indexing was stopped, and that's beginning to bite now 10 years later when people are paying real capital gains tax increases. 10 years ago, we had 12,000 or more personal allowance on capital gains. That is negligible now. There's no capital gains tax allowance. So any capital gains you've got on your commercial property, shares, and other investments are going to be taxed as well. So you're taxed on your income, taxed on what you buy with the VAT taxes, and then you're taxed on the profit that you make from that. And then lo and behold, after a lifetime of being promised that your pension is a tax-free investment where you can save for your retirement, it's not anymore. Yes, you can get tax relief going in up to a limited amount, but the pension funds are taxed to a degree. Don't forget that there is internal taxes have been introduced in the last 20 years, and now in the Halloween budget last October 24, we saw that inheritance tax is being introduced to include pensions. Now, not a lot of people pay inheritance tax, and that's because the gifts can be excluded, and first and second death can be excluded. But by including and adding pensions to the total, which previously weren't in the maths of this, suddenly, if you could have, if your pension portfolio is producing 5%, then a 500,000 pension fund is producing a 25,000 pension. Therefore, if you've got a good pension, you've got a good fund behind you, which is now liable to one of two options. It's either going to be lost when you die because it's annuity and the money's gone, and the annuity dies with you, but actually the government get a big tax chunk of that anyway. They just don't tell you that. You buy the annuity for the guaranteed income of your lifetime, and that annuity, when you die, doesn't stay with the investment company, the pension company. It gets its 45% tax going to the government. Now all pensions are like that because all pensions are added in to your inheritance tax calculation. So it's your property, your investments, your savings, your wealth, and now your pension fund as well. So any reasonably successful business person could have 3, 4, 5, a million, 2 million pounds in pension funds, which have saved very tax efficiently over their working life. That's now part of your inheritance tax liability. And therefore, real action needs to be considered. Not many people pay inheritance tax at the moment, but that's going to increase rapidly over the next 5 or 10 years as people are dying with significantly big pension funds that they thought would be free of inheritance tax when they built them up over the last 60 years, thanks to that Halloween budget. So how can you manage that situation? Well, pensions are fixed assets in the UK. You can still move them out. The government could change the law and regulation. We're still waiting for the final rules and observations on the non-dom status about how that's going to impact the changes going forward. And it could be that some tweaks in the next budget in March 25 could change that situation so that there is less options for people to move their pensions abroad. If you are an expat at the moment, you can relocate abroad, you can move your pension abroad and potentially get it into a tax-free location. It takes time, it takes process, there's potential to initiate that now. If you want more information and guidance on that, you can contact us at proactpartnership.com.